Hello, ladies and gentlemen, and thank you for joining us. My name is Kirill Tsenkov, and it will be my pleasure to host today's webinar at GDMfx. The topic of today's webinar is going to be an introduction to chart patterns. It is a powerful trading tool which is widely known, widely used by forex traders around the world. And today we're going to go through the most important types of chart formations, which all of you should be familiar with. Now, before I start, I would like to, of course, take this opportunity to inform you that if you have any questions or any comments, you should by all means use the chat feature of our webinar system. So you can send us your query. I'll be making regular stops every few minutes to answer all relevant questions. But whether your question is relevant to today's topic or not, you will definitely receive an answer in your inbox, in your email inbox, right after the webinar. And thank you for joining us once again. And now let's talk a little bit about chart patterns. Right. So basically this is what we're going to be covering today. First off, chart patterns and trading chart patterns, analyzing chart patterns is a small portion of what is known as technical analysis. So we're going to talk a little bit about what exactly is technical analysis and how does the chart pattern trading fit in the concept of technical analysis. Also, we're going to discuss the double bottom and double top formations, which are probably the most popular chart patterns, together with the head and shoulders and the various types of triangles. Okay, there we go. What is technical analysis? Basically, there are two types of analysis, two ways that one can analyze the financial market: the so-called technical analysis and, of course, fundamental analysis. Basically, technical analysis, the simplest possible way to explain it is using information from the past in order to try to anticipate what will follow, what will come in the future. By all means, you should keep in mind that you can only use past performance to anticipate the future, to try to get a certain level of certainty as to what you can expect. You cannot, by all means, get a guarantee of what's going to happen. And a very, very simple example to technical analysis is basically if for the past 10 years the month of February has always been a very cold month, then you can be quite confident, let's say, that the next February is going to be cold as well. But you cannot be 100% sure. You don't have a guarantee. As we know, there's always the first time for everything in life. So you can use information from the past, occurrences of different, let's say, bullish events or bearish events, spikes in the price of a certain trading instrument, declines or appreciations under certain conditions. You can use those in order to to anticipate their next occurrence, but you cannot use that as guarantee that a certain price movement will happen with 100% certainty. Now, there are two ways to approach technical analysis. There is the chartist's approach and the quantitative approach. There is a nice saying on the market which goes like, every chartist is a technical analyst, but not every technical analyst is a chartist. And this is just to illustrate the difference between what is known as a quant and what is known as a chartist. Basically, the chart is a visual representation of a significant set of statistical data. It's a visual representation designed to help your brain more easily, more efficiently work with that information. In other words, what we're going to look at today is chart patterns. Later on in our next webinars, candlestick patterns and the trend following. These are more of a visual approach to technical analysis, using the chart, using our eyes. And of course, if we were a quant, which is another thing, then we would be using formula. We would be using complex statistical and or mathematical modeling in order to make our trading decisions. And for those of you, of course, who are familiar or who are using trading robots, also known as expert advisors, that's how an expert advisor, a piece of software, would approach making technical decisions. It would use entirely formulas, and based on a certain result, it will make a logical choice, yes or no. So this type of technical analysis, which is entirely based on formula, on statistics, it's not impressed in any way by a chart, a picture. That's known as quantitative analysis, and those kind of analysts are actually known as quants. Today, of course, talking about chart patterns, we are going to take the chartist side of technical analysis, and we are going to be focusing on the most popular chart patterns. Now, once again, let me use the opportunity to remind you that should you have any questions or any comments, you can by all means click the button to raise your hand and we'll pass the microphone to you, or you can just use the chat to send us your questions. We would make sure to answer everything that's relevant to today's topic, and for everything that is not, of course, we will answer anyway. We'll just send you the answer on your email right after the webinar. Okay, there we go. Now, the first type of chart formation that I'll be talking about is the double top formation. It's a bearish reversal or a bearish continuation formation. In other words, it's showing us when the price is about to go down, or reverse to the downside, or continue going to the downside. Now, I've left this slide empty in the middle on purpose, so we're actually going to make a mock formation right now, draw up what a normal double top formation would look like. Basically, a double top formation occurs when the market advances to a certain high, retraces slightly, then tries to advance to that high, a little bit above, a little bit below, a second time, and fails again, and then reverses to the downside. Looks exactly like the letter M. We see the two highs, the two tops, right up here, and this is namely why this formation is known as a double top. It's quite easily spotted on the chart. That's what is making it a very popular trading chart formation. And there are a few different ways in which a trader can exploit this specific chart pattern. Basically, what we need to identify when we see two peaks, two tops on our chart is we need to identify first, once again, where are the two tops, and then the low between them, which is actually known as the neckline. So this level is known as the neckline. Right here. So once again, when we see the market moving in such a way, we might consider the possibility of a new double top. We see that there are two highs which are already formed. This being high number 1, this being high number 2. And obviously in between them we see our neckline. What we can do, what we can actually anticipate or expect, but not with 100% certainty, of course, is that whatever the distance in pips is between the two peaks, the two tops, and the neckline, this is what we can expect, this distance in pips, we can expect as our decline target, or our profit target if we want to enter a short position. Now, it's extremely important to note that if we're about to base a trading strategy on this type of chart pattern, the double top, the entry level or the entry rules are extremely important. In other words, when talking about technical analysis, which is of course based on past occurrences, the double top and double bottom formations are popular, namely because someone made the effort to count how many times those formations, those specific formations occurred in the past, and how many times the market reacted by going down, in the case of the double top, with this much and that much, or this many and that many pips. So with a good level of certainty, we can expect that the distance between the two peaks and the neckline is the same distance that the market might go further down if it breaches the neckline. So if we breach this level right here, we can expect market to continue all the way down by the same distance as we can measure it between the two peaks and the neckline. Should we just put a sell stop order at the neckline and our take profit order down here? Well, now this is going to give us the difference between a higher and a lower success rate. In other words, an aggressive trader might as well do it, might as well just place a sell stop order over there, but he will get a bigger portion of his trades would hit their stop loss. It's actually measured that if a trader waits for what we call a confirmation, a confirmed breach of the neckline, then he will significantly improve his success rate, but on the other hand will miss out on a few otherwise good opportunities on the market. Now what I'm going to do actually is I am going to switch to my MetaTrader platform right now, and we will be able to observe a few different double top formations that I've marked on my Euro-USD chart, and we're going to be able to see how price action developed after the formation itself was confirmed. Just bear with me for a second. There we go. Okay, so the first thing we actually see on our screen, I marked it with a little gray box here, is a small double top formation. Now, I should by all means state that a double top formation, especially when we're looking at a candlestick chart, does not have to be pretty or perfectly level or even symmetric in order to work. So don't get fooled by the fact that it's a bit skewed to the left or to the right, or that one of the peaks is slightly higher than the other. It's not so critical. What is critical, though, is that if we see a formation like this, we should be very careful with where and how we place our positions, how we make our trading decisions. In other words, the timing, market timing, is extremely important, and that's going to make a big difference in our success rate as a trader. For instance, we get rid of, there we go. If we look at the area I've highlighted in the middle of my MetaTrader chart, we will see a small double top formation. Now let's mark the two peaks and the neckline. An extremely useful tool to do so in the MetaTrader is the equidistant channel up here. So if I draw a line from the close of the first peak to the close, the highest close of the second peak, I'm ignoring the shadows on purpose, and then I will set up just a second. So I will set up my neckline. There we go. To correspond, the lower line of the equidistant channel to correspond with my neckline. So there we have it. We managed to mark a double top formation, which, as we can see, it's not perfectly level. It's not very beautiful, but still works just as well for us. Now, the way this works is the distance between the neckline and the two peaks is what we can consider our target here. I'm going to use the crosshair to measure it. There we go. That's essentially 15 pips. So from the point at which we penetrate the neckline line, or the lower line of the equidistant channel, we can put our target 15 pips lower. So somewhere down here. There we go. And that would be our take profit if we wanted to place a short position based on this double top. Now, let's consider another one. Just scroll back a little bit until we see a double top. There we go. It's an even smaller one. Once again, not perfectly level. We can use, once again, the equidistant channel. Saves some of our work as it draws two parallel lines at the same time. So I've connected the two peaks, and then I'm going to move the second line to correspond with the neckline level. And we can get our entry level projection. So the lower green line, in other words, is our entry level. This is the level at which we can consider that the double top formation is confirming itself. I should state, of course, and this would apply for all the other chart patterns that we're going to look at today, that if we're more of a conservative trader, if we want to stay on the safe side of the market, we might want to wait for a confirmed breach of the lower green line before we can consider entering the market. Let me just demonstrate that. For instance, let's take a look at that big double bottom. Okay, a double bottom is basically the same type of formation as a double top. It's just reversed. It's the other way around. It's basically giving us a good bullish reversal or bullish continuation signal. In other words, it's showing us that the market's about to reverse to the upside, or it's about to resume its movement to the upside. Now we see two lows which we can connect using the equidistant channel, like so, and then the higher line, we will move it to correspond with our neckline right up here. And there we go. Now we see the higher green line. Here is the projection of our entry level. We want to wait until the market starts pushing above it before we can consider opening a buy position. First off, let's think about our target. We can use the crosshair once again from the neckline down, straight down to the two lows. That's 33.9 pips, or let's say 40 pips. Okay. So let's roughly place it here. The red line is going to be our take profit level. Now, looking at this specific double bottom, what I would like to see as a conservative trader before I open a buy position is I would like to see a confirmed breach of the neckline. And let's define what exactly is a confirmed breach. It's quite simply put, when we see a candle opening below the green line and closing above it, like we see in this case, let me highlight it for you. There we go, right here. Now this specific bullish candle is what we're looking at. We see that this candle is opening below our entry level projection, and it's closing just above it. Okay, this is a breach, but it's not yet a confirmed breach. What we can call a confirmed breach is when the next candle, one or two candles later, but not more, when one of the next couple of candles goes even higher than the previous one. For instance, the candle that opened below and closed above the entry level line, the green line, this is what we can call a signal candle. We want to see one of the next few candles continuing even higher, and only then can we say that this is a confirmed breach of the set green line or entry line, or you can call it even a resistance line in this case. Now this simple rule, the confirmed breach rule, I use with every one of my trading styles, whether I'm waiting for a breach of a support line or of a resistance line, or even a projection like this, entry level line. But I would always wait for a confirmed breach before considering my positions. Otherwise, very often you will see how the market pushes higher above, let's say, a given resistance line, but then goes right back down and continues even lower, and you end up losing a nice trade. This is also known as a fake out or a fake breach. So you can reduce all those losses due to fake outs simply if you wait for a confirmation. So in this case, our signal bar, which we marked on the chart, closes above the green line. What we could do is we could put a buy stop order 5-10 pips above it. Let's say up here. I'm going to make this line blue. There we go. We can put our take profit at the red line. This is the distance we measured between the two lows and the neckline. So from our entry point, we're going to put a take profit at the same distance higher. In this case, we measured 40 pips before the neckline and the line between the two lows. So we're going to put our take profit 40 pips higher than the neckline. Now, we should always, of course, use a stop loss, regardless what we're trading and what we're doing. We should always have a stop loss in place, a golden rule of trading. So when talking about a double top and a double bottom, there are a couple of ways to organize your stop loss depending on your risk preference, of course. More aggressive traders would sometimes put their stop losses 5-10 pips below the lowest extreme of the signal candle if they're using the confirmed breach rule. So in this case, somewhere down here, and let me make this line red again. Some traders will just put their stop loss in the middle between the line connecting the two lows and the neckline, which once again in this case would be pretty much where our lower red line is right now. And traders who want to play it a bit safer, but a bit safer in terms of success rate, but not in terms of possible loss, would put their stop loss below the two peaks, even lower, I mean the two lows, sorry. So even lower than the two lows. Why? Well, simply because the market tried to push down 2 times and it failed. The first time it went up to the neckline, then it tried a second time to push lower and it failed pretty much at the same level, and now it's trying to reverse to the upside again. So namely, there is something stopping all the sellers at the level at which the two lows are. So a lot of traders would put their stop losses a bit lower than that level as well. So once again, in this case, what we did is we connected the two lows, the two bottoms of this double bottom with a line, and we made a parallel line which is projecting from the neckline, the high between the two lows, to the right. This line we called our neckline. This is the higher green line, and we started waiting for the market to breach it, to breach higher, to give us a confirmed breach, at which point we opened, let's say, a buy position. We placed our take profit at the same distance from the next neckline, the distance between the neckline and the two lows, this is how much higher, at the same distance higher, we put our take profit. And our stop loss, if we want to aim for a higher success rate and are willing to risk losing more pips, and our stop loss essentially we placed below the two bottoms, so slightly below the two bottoms. Now in this case we can see that this specific double bottom was successful. It did give us our almost 40 pips of profit. As a matter of fact, the double bottoms and double tops are quite successful formations, but I should definitely state that it all depends on the rules we are following as to when and under what conditions to open our position. If we do not wait for the formation to properly form itself, to give us some sort of confirmation that this indeed will become a double bottom, then our success rate sadly would be significantly lower. I've seen a lot of cases where trading double bottoms and double tops produces a bit less than 50% success rate, which in other words means pretty much a consistent loss, especially when we consider the other tiny expenses we're picking up every time we open a position. So the best thing to do if we're considering trading double tops or double bottoms is, of course, to sacrifice a portion of the positions we see, in other words, to miss a part of the opportunities we see on the chart, but to be safer with those that we want to commit to. And why we miss a part of those formations? Well, simply because they don't answer to our rules. And in this case, our rule is be patient, don't be greedy, don't enter too soon, and wait for a good confirmation before you place your position. Now in the case of this, let's say, double bottom or double top, because basically it works exactly the same way for double bottoms and for double tops. It's just that for a double top everything is upside down, while right now we're demonstrating on a double bottom formation. Here we go. Let me get rid of a few lines on the chart, and I'll show you another way to go about opening a position when you spot a double bottom on your chart. For instance, there are a lot of traders who would draw up their equidistant channel like I do and wait for a confirmed breach of the higher green line. There are a lot of traders that are going to do something else, a different option, and that option is you draw up your equidistant channel, you connect the two bottoms, you place the higher parallel line on your neckline to give you a good idea as to where you should be looking for some resistance. And then they do something else. They connect this line with the neckline, like so. Draw a little trend line from where the down movement first started, and connect the two dots. Connect the point at which the down movement started to the second point, should be at the neckline, the high between the two lows. You would get a downward sloping trend line like I just did. Now some traders, which would follow a more aggressive approach, would essentially look for their entry somewhere in between the green and the red line, right here. They would put their stop loss below the red trend line, and their take profit would pretty much be based on the same rules. It's the distance between the two green lines. Is how many pips they're going to place as a take profit. Once again, this is a bit of a more aggressive approach, but it does produce good results as well. Personally, I tend to wait for a confirmed breach of the neckline before I make my decisions. Right, once again, let me use this opportunity, ladies and gentlemen, to remind you, should you have any requests or any comments, please, you can use the chat function of our webinar system. You can send those questions to us. I'll be making regular stops to answer everything that is relevant to this specific topic, or if it's not really relevant, we will anyway send you an answer on your email right after the end of the webinar. A few minutes ago I did spot a nice question I would like to address. It's whether you can get the recordings of the webinar. Yes, by all means, we already did send a reply to this, but let me mention it anyway. We will be sending out the links to the uploaded recordings to absolutely everyone who received an invitation for this webinar. It wouldn't really matter if you attended the webinar yourself, if you were here or not. You can still get the recordings. Pretty soon they'll be available on the GDMfx website. So by all means you can use those recordings, you can watch them. You don't really have to remember everything that's being shown today. I do think it's a bit of an information overload anyway. Okay, right. Well, let's proceed further a little bit. I'm going to scroll forward and you're going to see a next small double bottom formation. You'll see that I've already drawn the two green lines, the one connecting the two lows. And once again, as I said, the formation doesn't have to be perfectly level. It doesn't have to be beautiful. We just need to follow our rules and we can use it to our advantage. In this case, we can see a good confirmation above the higher green line as well. And then we can see, without even measuring, but we can pretty much sure that this was a profitable position as well. Now, what did I mean when I said don't be greedy? First off, here is our confirmation. And second off, our take profit should not be bigger than this distance here, the distance between the two green lines. So from here, we shouldn't put our take profit too high. Okay, that would be a mistake. We should not be too greedy. If we measure the distance between the two green lines at 20 pips, so we don't put our take profit more than 20 pips. Simply because that would not be in line with what the formation is projecting and what we are anticipating. Of course, in our Forex risk management webinar later on through the month, we are actually going to demonstrate how you can properly squeeze out as much as you can from a profitable position without limiting yourself to a small take profit and without exposing yourself to too much risk with a huge stop loss. So by all means, if you do have the time, we're going to be very happy to see you on our Forex risk management webinar. But if not, you're going to receive the recording anyway. And once again, by all means, you can just send us an email to webinar at GDMfx.com. If a question pops out later on through the day or week, you can send us an email. We're here to help. Now, the next formation you're going to see, and let me just remove those markings so we don't get distracted. This one, marked it with a little X. Now, in the case of this formation, we see that it's pretty much a nice double bottom, sorry. But essentially, it's not really making anything for us. Let me go to a smaller period. There we go. So we see that there is a penetration above the neckline, which is right here. Just a second, there we go. So we see our neckline right here, and we see that the price penetrated above it, but by all means it did not reach the target, which should be maybe somewhere all the way up here. Or maybe actually it did reach it, but we can't be sure. This is a very good illustration, a very good example as to when a chart pattern like the double top and the double bottom are applicable. Basically, we're talking about reversal patterns and continuation patterns. So reversal of a trend, of a movement, higher or lower, or continuation of a movement, higher or lower. So if the movement is not high, it's not moving up or it's not moving down, if it's moving sideways, the best thing to do would be to stay clear of such formations, since we don't have a, let's say, a movement down, a down movement to reverse in the first place, or a movement up to continue in the first place. We just have a sideways movement, and as a matter of fact, we might as well continue in this sideways movement for the unforeseeable future. And this is pretty much what really happens in this case. Therefore, when the market is moving sideways, just to sum it up, it would be a good idea to stay pretty much clear of double bottoms and double tops we spot. Now let's zoom out just a little bit. There we go. So right here we're going to see a bigger double bottom formation. Okay, now you notice that I've drawn my lines again. Let's do it from the beginning so we can connect the two lows, the two bottoms. We remove the higher parallel line, so it corresponds with our neckline, with the high between the two lows, and we get our entry-level projection. In this case, it's here. We see that the market penetrated the higher green line, and we actually even see that the next candles continued even higher, which is a confirmation. It's a confirmed breach, so we could enter our buy position. Now once again, we could have placed our stop loss in the middle between the green lines, and we can see that we would have been pretty close to it. Or we could have placed it lower than the two lows if we want to have a higher success rate, but we are also okay with risking a bit more pips. Now this is a very good example. We can see that it definitely reached its take profit, which in this case would have been the distance once again between the two lines. There we go, 23 pips. So from here, 23 pips up, all the way up here. There we go. Yes, we definitely did reach our take profit target. Okay, so this is pretty much it for the double bottoms and the double tops. Basically, we can see them on the bottom or on the top of a bearish or bullish trend. They might give us a good signal as to the trend is trying to reverse, or we might see them at the top or bottom of a retracement of a trend, which might again give us a good indication that the retracement is about to reverse and the major trend's about to resume, to continue. We can base a trading strategy on double tops and double bottoms, but the difference between a high success rate and the unimpressive success rate would definitely come from the rules we follow as to when to place our position, when to enter the market. Once again, I would personally wait for a confirmed breach of the neckline before entering a position, and some more aggressive traders would just draw up a line such as this from where the down movement started to the neckline, and they will enter when it is breached somewhere down here. So significantly sooner, in other words. Okay, now, if you can just bear with me for a second, and we will demonstrate how a head and shoulder and a reversed head and shoulder formations look like. There we go. Now, once again, I've left the middle of this slide empty for a reason. We're gonna draw up how a head and shoulder and how a reversed head and shoulder formation will look like together. Basically, it is once again a formation which is signaling the possible reversal of a bearish or bullish trend, or the continuation of a major bearish or bullish trend. It is this specific formation is called head and shoulders for a funny reason, basically because on the chart it looks a little bit like someone's head and his shoulders. It would look like this. There we go. So we would have our neckline down here. We would have our two shoulders here, and the higher peak in the middle would basically be what we're going to call our head. This is how a head and shoulders formation chart pattern would look like. And of course the reversed head and shoulders is basically the same thing upside down. Once again, our take profit target would be the distance between the head and the neckline. So this distance, let's mark it with X, should be the same as the distance between the neckline and our take profit. This should be X again. And this is our neckline. Now, once again, it's a very, very popular chart pattern, a very popular formation. And obviously, just as the double bottom and double top, we can get a very good result out of it if we're very strict about our entry and position management rules. In other words, once again, we need to be very careful as to when and where exactly we enter the market if we're trying to trade one of those formations. In this case, the proper entry would be somewhere here, on the second shoulder. So we need to see one shoulder, we need to see the head, we need to see the second shoulder start to form up on our chart, and only then we can actually start thinking that, hey, maybe this is a head and shoulder formation. And when we see that the second shoulder is starting to breach the neckline lower, only then can we actually consider trading this formation. And in the case of a head and shoulder, we would be placing a short position. Once again, I would personally wait for a confirmed breach of the neckline before entering, although I could end up sacrificing a few pips from my possible profit potential. But at least my success rate would stay a bit higher. Now, right, why not? Let's draw up a reversed head and shoulder formation before we move on. This is how it would look. There we go. So basically it looks like the normal head and shoulder. It's only upside down. We will have our neckline here, the two shoulders, and our head down here. Our profit potential is the distance between the head and the neckline. And we should wait for a confirmed breach of the neckline at the second shoulder before we place a buy position. Now the stop loss we can place just below the shoulder. So down here we can put our stop loss, and our take profit would be up here. The distance between the neckline and the take profit, it's going to be the same as the distance between the neckline and the head. Oh, right. I do see I do see a question. Can we see that on the chart? Well, yes. By all means, I'm gonna switch back to the MetaTrader in a few moments. We're going to try to identify a head and shoulder, hopefully a reversed head and shoulder formation on the chart as well. Although it does take some practice before you start distinguishing them. There is a bit of too much noise on the candlestick chart. A lot of shadows up and down. To be honest with you, in the beginning when I first started out trading, I used to see formations pretty much everywhere. But it's by all means, it is a very useful tool, and you can definitely base a trading strategy on top of chart patterns, or you can use them in addition to your existing trading strategy, just to give you, let's say, a second confirmation on whether you want to enter a position or no. Okay, so let's move back to the MetaTrader real quick, and we'll be able to search for a few head and shoulder formations. There we go. Excellent. Let me just remove a few things that we placed on the screen. There we go. Okay, excellent. So if you look at the middle of the screen right here, let me zoom in a little bit. You're going to spot something that looks like a head and shoulder. As I said, it doesn't really have to be beautiful or perfectly symmetric to be a formation or a good formation. For instance, let me just mark it up for you. We're looking, sorry. Okay, so we're looking at this thing right here. So we can see one shoulder, second shoulder, and of course we can see the head. It's pretty clear up here. So one shoulder, second shoulder, and our neckline. It's not perfectly leveled, not very symmetric, slightly skewed to the side, but it's a head and shoulder nonetheless. Now let's use the MetaTrader tools to try to draw it up, mark it up, and obviously see where our take profit would be, where we could place our stop loss. So the neckline should be right up here. I'm using the equidistant channel again, so it's going to draw up a perfectly parallel line to the neckline, which I'm going to place on what I consider to be the head of this head and shoulder formation. Now let's use the crosshair and measure the distance between the two green lines. It's 22 pips. So 22 pips lower is where we're going to put our take profit. There we go. It's a rough approximation, of course, but it would be something like this. Now, I did mention to you that I would be waiting for a confirmed breach before I enter the position. And once again, what is a confirmed breach? It's basically when we have a neckline or a support level or a resistance level. In this case, it's a support level, the next line. The neckline, the lower green line, does represent a support level. Actually, let's put a little text here, a little label. There we go. So the lower green line can be considered as a support level. What I would be looking for, what I would call a confirmed breach, is when I see a candle opening above this support level. For instance, here, this one is opening above it. Then closing below it, so it's closing all the way down here. When I see a candle like this, I would call it a signal candle. And I would place my sell stop position 5 or 10 pips below its bottom extreme. It's the lowest point it reached. And if one of the next few candles continues even further down, then I would I would say that this is a confirmed breach. If the next candles don't continue further down, but reverse to the upside, then I would call it a fake out, a fake breach, and I wouldn't enter the position. In this case, we can see that my confirmation actually happens all the way down here. So it pretty much ate most of the profit potential. So this is essentially, this is the trade-off when you're waiting for a confirmed breach. You are going to sacrifice a portion or maybe even the entire profit potential that you have, but you're definitely going to significantly improve your success rate. And by success rate, once again, I mean the number of times you're profitable, number of times you hit your take profit versus the number of times you hit your stop loss. Okay, excellent. That's a pretty good, I see a pretty good question, and it goes like, can this confirmed breach rule, can this be used with other trading styles? Yes, it can. You don't have to use this only with when trading a chart pattern like a double top or a head and shoulder. As a matter of fact, whether you want to, let's say, open a buy position if the price defeats a certain resistance level, or whether you want to open a sell position when the price action defeats breach is lower than a certain support level, you can definitely apply this entry rule, the confirmed breach rule. It is going to have a good effect. By all means, it can only improve the success rate simply because it's protecting you from fake outs, from a fake breach. And let me just give you an example. As a matter of fact, I'll clear things here a little bit. Okay, so consider the red line we have in the middle of the screen, and what I'm looking at is right here in the middle. There we go. Now, if we consider this specific candle as our signal candle, as we can see, it's opening below the red line and it's closing above the red line. We are looking at this red line, we think it's a serious resistance level, and we think that if the market breaches higher than this line, then we can safely buy. So we see one candle which is opening below the red line and then it's closing above this red line. This is what we've pointed to, this candle. We call this our signal candle. And then we want to see one of the next couple of candles, the next few candles, continuing even higher, somewhere up here, and then we can say that we have a confirmed breach. And as we can see, the next candle actually goes straight back down. So this is a very good example of a fake out, a fake breach. And if we were not following, let's say, the confirmed breach rule, we would have already opened a buy position and then would go in the wrong direction by quite a bit. Okay, there we go. Now, it's a bit more tricky to see a good head and shoulder or reversed head and shoulder on your screen. Let's scroll back a little bit. And maybe we can see a good reversed head and shoulder, which we can use for demonstration purposes. Well, as I said, it does not by all means have to be beautiful or perfectly even, so we can use it. Yes, and there we go. Okay, let's consider something I just saw on the chart, not marked. Oh, this is where we're looking right now, and we can say that this is a reversed head and shoulder. We see one shoulder, we see a second shoulder, and we see our head in the middle. Not very symmetric by all means. We're going to have our neckline like here, headline here, and our take profit up here. Now just a second and let me use the equidistant channel. So I'm connecting the two shoulders and I'm getting my neckline. And let me zoom in a little bit so you can see better. Ah, there we go. Okay, so as I said, it's not very beautiful. I'm going to mark it up once again for all of you. So we see one shoulder, second shoulder, and our head. This is a reversed head and shoulder. We've connected the two shoulders to create our neckline. Now we can use the crosshair to measure the distance between the head, the neckline, and that's 39 pips. So from somewhere up here, 39 pips, all the way up here. That's where our take profit will be. And in this case, if we are waiting for a confirmed breach, we'll have to wait for quite a bit. because it happens all the way up here. If we're a bit more aggressive, we might have entered down here as well, but as we can see, then we would be stuck waiting for quite a bit. Let's see if we can find something which is a bit more clearly defined in terms of visibility on the chart. Ah, there we go, perfect. Okay, it's quite a big formation. It's in the middle of our screen. There it is. Okay, so we can consider, just a second, we can consider this to be our first shoulder and this to be our second shoulder, and then we have a huge head in the middle. So our neckline will be down here, and all of this would be our profit potential. This is a head and shoulder, so we're going to be waiting for a sell position down here. Okay, there we go. Now let's use the MetaTrader tools. We're connecting the neckline between the two shoulders, and we're going to bring the parallel line all the way up to the head, so we can use the crosshair to measure the distance between the two lines, and it's at 108 pips. So it's quite a huge formation. Let's see if it's actually a profitable one. Might as well not be. Well, we did manage to reach 80 pips lower, and then ultimately it went too high up, so by all means we would have hit our stop loss regardless of how big it is. But basically a good reason as to why that was not a very good formation is the fact that, as we can see, the market was moving pretty much sideways when we look at the bigger picture. And once again, we do need a good direction up or down if we want to trust a double bottom or a head and shoulder or a double top or a reversed head and shoulder formation, simply because it is a reversal or a continuation. If we do zoom in though a little bit, we would see that it was quite a good double top in the middle there on what we identified as the head of the huge head and shoulder formation, which would have given us a great buy signal, a great sell signal, sorry. Okay, excellent. Now let's talk about triangles. Now the double bottom, the double top, and the head and shoulder, and the reversed head and shoulder are great formations. They're pretty popular, extremely popular, I should say. Pretty much all the traders out there know what's a double bottom and what's a head and shoulder. Triangles, on the other hand, are also very popular, but they're a bit more tricky. Simply because they're continuation, basically continuation patterns only. So a triangle essentially is showing you that if the market was moving higher and higher before it formed, then if it confirms, it should continue in the same direction. A lot of traders are making the mistake of trading a triangle as if it was a reversal formation, which is not really the case. Let me now just switch back really quickly to our presentation, and we're going to draw up one of those formations together. Okay, there we go. Let's grab the marker. What is a triangle formation? Well, let's consider that the market is doing this. This is what we would call a triangle formation. Okay, there we go. In this case, actually, it would be called a symmetric triangle. Simply, we see that the market is in a downtrend. Then it starts retracing down here, and it forms a series of highs and lows, one following the other. And in this case, we can see that every next high is a bit lower than the previous, and every next low is a bit higher than the previous. So essentially, we can see that the price action starts squeezing in. Into what we can identify as a triangle. Okay, there are other types of triangles as well. In this case, this is a downtrend, so when we see this symmetric triangle forming up, we should be waiting for a breach down here so we can consider our short position, as this is namely a continuation pattern. If it breached up here, it would no longer basically be a triangle formation. Then we would simply have a skewed double bottom with its neckline here, which is, by the way, also known as a 1, 2, 3 formation. But by all means, that's no longer a triangle. It's just a double bottom, and a double bottom is a reversal formation. But if we stay at, if we don't violate the triangle in any way, then it's a continuation pattern, which is showing us that the market is going to continue in the same direction. So this is our point of interest. This is the confirmed breach we want to see, and then we can consider another short position. Of course, the profit potential, it's pretty much this, the distance in the beginning of the triangle. This is what we can set up as our profit potential. Now let's draw the opposite. If the market's in an uptrend, this is how a symmetric triangle would look like. Once again, a series of lower highs and higher lows. In other words, the price action is squeezing into a triangle. And then when we see the penetration here to the upside, then the formation is confirmed. We can consider buy positions as the uptrend is basically continuing, it's resuming. So the triangle, the symmetric triangle, is quite a good continuation pattern. If on the other hand the market continued down here, it would no longer be really a triangle, it would simply form a double top, and upon breaching its neckline down here, we might consider short, as the market is about to reverse to the downside again. Okay, so as we already said, a chart formation does not need to be beautiful. We don't need to see it perfectly even on our charts in order to use it. And this is once again the case with triangles as well. What we just illustrated is basically the so-called symmetric triangle. But there are also the ascending and descending triangles as well. Let's consider this. The only difference is that the highs in this case are pretty much on the same level, while the walls keep going higher and higher. So we see a good ascending triangle. Once again, it's a good continuation formation. If we see a confirmed breach, here we can consider new buy positions. If the opposite happens, the market penetrates below, then this is just going to be a triple top or even a channel. It's no longer going to be a triangle formation, it's going to be another type of formation, which might as well signal reversal. And this is actually a pretty good point for me, a pretty good moment for me to emphasize on the fact that we need to be patient. Believing in a formation too soon might basically cause quite the headache. In other words, we look at our chart and we decide, hey, you know, I'm seeing the greatest ascending triangle ever. And let me illustrate that. So we're looking at our chart, we see this. And we decide, you know, hey, this is a great ascending triangle, I'm going to buy. Actually, we still have not seen a confirmed breach above the higher resistance line. But we're buying anyway. We think it's a great ascending triangle. And then this is where we get our surprise. The market actually does this. And it's not really a triangle anymore. Now it's actually more of a channel or even a double top. So if it penetrates down here, market is going to reverse to the downside, and we would have just made a big mistake with our buy position. So once again, we need to be patient. We don't want to rush into things. We need to wait for our confirmation before we can trust any triangle formation, head and shoulders, double tops, double bottoms, doesn't matter, but we should by all means be patient. Now let's consider a few descending triangles. So we're in a downtrend, market is moving down, and then we see something like this. This is not a symmetric or symmetrical triangle, simply because the lows are pretty much at the same level, but then the highs are lower and lower and lower. So this is a descending triangle. Once again, it's a good indication that the downtrend is about to continue. So it's a continuation pattern. But we should by all means wait to breach the line that's connecting all the lows. We need to see a confirmed breach. Otherwise, we might as well get a fake out, or in other words, if we don't breach down here, if the price goes up here, then it's no longer going to really be a triangle formation. It's going to be another type of formation again, like a double, triple top, or a channel, or even a rounded bottom. And then we are basically putting our money on the wrong type of a position. So we need to be patient. Okay, excellent. Now, I see that there's quite a lot of questions today, not like on our last webinar when you were a bit too shy. We will, of course, send you answers to each and every one of you on your emails, but once again, let me please use the opportunity to mention that we will be answering only questions that are relevant to the topic right now. For everything else, you can just check your inbox at the end of the webinar. And since more of you are asking, let me confirm once again, yes, you will receive the recordings of all of our webinars. We're going to be hosting a couple of webinars every week, pretty much every week. So you're going to receive all the recordings in your inbox by all means, yes. And if you're missing anything, or even if you have a suggestion for a webinar topic, you can just send us an email at webinar@gdmfx.com, and it will be our pleasure to assist you in any way we can. Now, let me use this opportunity to ask you to please consider any and all questions you might have right now. We're going to make a short break in the next 10 minutes so that you can consider if there's anything you want to ask us, and then we will go into our question and answer session for this webinar, after which, of course, we will call it a day, conclude today's presentation. Okay, excellent. So basically, we will be back in 10 minutes, and we will start with our question and answer session. Right. Hello again, ladies and gentlemen. Thank you for standing by. Now we are ready to go into our question and answer session for today's topic, of course, which is chart patterns. Now there are quite a few questions today. I would like to address those that are relevant to the topics right now, and we will make sure to send you answers to everyone else on your emails right after that the webinar. So the first question that I see, it's if we can go back to a small illustration of a reversed head and shoulder pattern again. Yes, by all means, it will be my pleasure. Let me just change the presentation back for all of you. And let's draw up a small reversed head and shoulder pattern. Okay, this is how it would look like in your chart. Might be skewed to the left side, might be skewed to the right. It does not, once again, it does not have to be beautiful. It does not have to be perfectly symmetric or perfectly even to be a head and shoulder pattern, reversed head and shoulder pattern, or a good trading opportunity. So we have our left shoulder, we have our right shoulder, and the head is in the middle. If we connect the two highs, which are between the two shoulders, we will get our neckline. Now, one way of setting up the most widely used way of getting your profit potential is if you measure the distance between the head and the neckline. So if this distance is, let's say, 100 pips, then our take profit would be 100 pips higher than the neckline. And here is our neckline. There we go. This is our head, and those are our shoulders. This is once again a reversed head and shoulder. When we see something like this, we might want to consider buy positions upon a confirmed breach of the neckline up here. Okay, there we go. Now there is also another way to choose or decide upon your profit potential. It's a bit more conservative, I should say. Here is the same reversed head and shoulder. We have our left shoulder, our right shoulder, our head, and our neckline, connecting the highs between the two shoulders. Now what we can do is we can actually measure the distance of the slope here between the head and the neckline, and then measure the same distance from the second shoulder, the right shoulder, as our take profit. So if this is 10 pips, this should be 10 pips as well. Now obviously we would be going in after quite the smaller profit potential, but on the other hand our success rate should improve as well. We can consider opening our position on a confirmed breach of the neckline, or even lower if we want to be more aggressive, somewhere above the right shoulder, the second shoulder. Our stop loss can be placed below the head, all the way down here. if we want to have a higher success rate but are willing at the same token to risk losing more pips. Or we can put it above the two shoulders as well. This will give us a lower success rate, but every time we lose, we're going to lose a smaller amount of pips and obviously smaller amount of cash as well. Okay, the next question I see, it's once again regarding a confirmed breach. What do we understand by a confirmed breach? Okay, so let me draw up a line for you. Imagine this is a resistance line, and we believe that if the market pushes higher than this line, we want to buy. So what we would like to see is we would like to see a candle which is opening below the line, the resistance line, and closing above it. We do not care about its shadows, its higher and lower extreme. We want to see open, below, close, above the line. Now we are going to call this specific candle our signal candle. So this is our signal candle. And if we see that in one of the next few candles, one of the next one or two candles is continuing even higher than the highest extreme of the signal candle, let's say 5, 10 pips higher, then we can say that we have a confirmed breach. So what we're going to look for after we identify our signal candle is we're going to look for the next candle to do something like this. So we needed to proceed higher than the highest extreme of the signal candle. And we call this a confirmed breach. What we call fake out or a fake breach, type of breach that we do not necessarily want to trust, is, once again, let's get our resistance line. Let's say we have our signal candle. We see that it's opening below and it's closing above the resistance line, the orange resistance line. Now, if the next candle does not proceed higher than the signal candle's high extreme, if it does, let's say, something like this, then this is not a confirmation because we want to see it go significantly higher. We want to see it go 5 pips at least, or maybe even 10 pips, depending on our risk preference, of course, higher than the signal candle's highest point. In this case, we have a fake out. We do not see a confirmation. Let's see a confirmed breach. And it's working in exactly the opposite way if we're looking for a confirmation to the downside, confirmed breach below a certain support level. Now let me illustrate that for you. Let's say that this is our support line, and we think that if the market breaches below it, it's going to be a good selling opportunity for us. What we want to see is we want to see one candle opening above the support line and closing below it. So we need to see it open above here. It's going to be our open. We need to see it close below the support line. Now if this happens, we can say that this is our signal candle. There we go. So this is our signal candle. And what we would like to see is we would like to see one of the next couple of candles proceeding even lower, so surpassing the lowest extreme of the signal candle. So if we see something like this, then we can say that we have a confirmed breach, and we can open our sell position. If we don't see this, if the next candle does not proceed lower than the lowest extreme of the signal candle, then we can call it a fake out and remain waiting. Okay, excellent. Well, once again, let me use the opportunity to say thank you to everyone for joining us today. Kirill Tsenkov is my name. I'm the Deputy Development Director at GDMfx, and once again, it has been my pleasure to host this trading webinar for you. Make sure to visit our next webinars as well. We still have quite a lot of exciting topics to go through. And by all means, once again, let me reassure you, you will receive the recordings of all of our webinars. We will make sure to send you the links in your inbox. And if you stumble upon any questions or anything that you forgot to ask us right now, please do not hesitate. Just send us an email to webinar@gdmfx.com, and we will definitely take care of your query. Right, excellent. Well, let's call it a day. This basically concludes the introduction to chart patterns topic of the day. Once again, definitely my pleasure. Good luck with your trading. Have a nice day.